In 2019, like I said, 5 sales desks controlled 80% of the trading. The share of trading taking place in the United States, it says, declined to 17% from 20%. So just a 3% drop. Just less trading going on here on the retail side, on the bank side, on the institutional side, the government side, the whole thing. 3% less over the course of 3 years. Not a big change. In contrast, in the UK, they're up by 6%, going to 43% of global activity in 2019. So UK traders are on the rise, United States traders maybe on the decline slightly. The interesting thing here, mainland China is up to $136 billion in 2019, or an 87% increase in their active traders since 2016. That is extremely substantial to me and stands out to me because the US only declined by 3%, the UK is up by 6%, China's up by 87%. That is substantial growth, and I think that needs to be something we keep an eye on year on year on year. Are more brokers coming out of China? Are more traders just, showing up from China? We need to watch that and start to see how that affects the retail side of the market. The last point here, talking about geography, it says the share of FX trading in the leading Asian financial centers, which is Hong Kong and Singapore and Tokyo, declined slightly, just to about 20%. So again, not a huge change over 3 years there. The main change, the biggest change as far as where our traders actually sitting when they hit the button, China. Most of it changed in China. US decreased a little bit, UK increased a little bit, China was where it's at. This chart here on a net basis shows just the difference on a daily basis between the spot transactions and the foreign exchange swaps. You can see the swaps are up to 3,200, while the spot transactions are just at about 2,000. Now, the outright forwards, the currency swaps, and the options don't even come close to these two. The majority of the market is moved between the spot and the swaps. Us in the spot, the big banks, the big guys in the swaps. That's how you can keep it in mind. And now that you understand where the market is moving things, how the market is moving things, what the players really are, here we're going to break down the size of market share that each currency controls. The first one, I've said it already, is the dollar. The second one is the euro, and you can see how it's changed each year. This year, the euro is making up about 32.3% of all daily turnover. The pound and the yen, both right behind that, the yen at 16.8, the pound at 12.8, and then underneath that, the Australian dollar at 6.8, CAD at 5%, and the Swiss franc at 5%. Now, the reason that these numbers add up to more than 100, if you go down this list, they have to add up to 200 because each currency pair is 2 pairs. It's never just one. So when you look at this, if you're someone who loves trading these pairs that are down here on the list, keep in mind that the broker is going to have a hard time getting liquidity on pairs that are not being traded. You need to focus on the pairs at the top of this list here. The dollar, the yen, the euro, the pound, the Australian dollar, even the New Zealand dollar is way down here, under the yuan and under the Hong Kong dollar. So it's interesting to see NZD down the list. So as you're moving forward, keep in mind dollar, euro, yen, pound, Australian dollar. That's where the money is. And more to the point, you have more money in the pound every day, in the yen every day than you do in the Australian dollar, Canadian dollar, and Swiss franc combined. So just keep that in mind when you talk about, I want to be in a liquid pair, I want to be in something that moves. If we keep going, we can actually break this down by currency pair. Now, they wrote it as USD Euro, but for us as traders, it's labeled Euro USD. It's the inverse. It's the same thing. You can see Euro USD is making up 24% of daily turnover. That's substantial. A quarter of the market in the spot market every day is happening on Euro USD. Take that a step deeper. The next one down is USD JPY, then GBP USD, then AUD USD, and USD CAD. The pairs that we all know are tradable, but you need to see the difference. It is substantial. We're talking USD CAD, which everybody loves to trade, only at 4.4% of daily turnover. Compare that to the euro dollar, we're talking about 24% of daily turnover. That's why CAD gets choppy. Euro USD doesn't as much. You have to keep that in mind because that's where the money is. Remember I said at the beginning of this video, we're following the money? Even here, look at Euro GBP, 2% of daily turnover. Euro JPY, 1.7%. AUD JPY, 0.5%. And then other currency pairs I think was important to label here at 1.6%, a lot bigger than a lot of these other ones you see here. What's in that other currency pairs? Well, that would be Pairs like the pound, pairs like the New Zealand dollar, GBP NZD, one of my favorite pairs, that's included in this 1.6% at the bottom. So now you can kind of see the pairs where the money is being moved, which pairs are trading the most, and that helps us decide which pairs are best to trade. I want to round up the survey here with the countries that are actually trading the most. The number one we already talked about is the UK, 43%. The United States is right behind them, second at 16.5%. It's these other numbers that I'm interested by. It's the Hong Kong at 7.6, it's Japan at 4.5, it's Singapore at 7.6, Switzerland at 3.3. Those emerging ones are interesting to me because I'm going to keep an eye on these every 3 years with this survey. Look, France at 2%, Germany at 1.5%, China coming up 1.6%. Go back 6 years, this was half of what China was doing. Half of it, more than that, right? And even Australia, 1.4%. So these are, and Canada, look, 1.3% as well. So these are the countries that we know traders are active in. So when we talk about which currency pairs should we be trading, you now know which pairs have the most volume, which currencies themselves have the most volume, and now I'm showing you the countries that are trading the most. So knowing those 3 points, knowing the countries, knowing the pairs, and knowing the actual currencies, how much volume they're doing on their own separate from the pairs, that builds us enough information. It gives us enough information to know which pairs we should be trading. And for me, I translate all of this information from the report into one simple statement. I think that if you focus on solid, healthy economies, healthy to the point that I mean we're developed economies, not speculating on Trump and the China trade war, not speculating on the Mexico and Canada and United States agreement, not worrying about that. Just looking at countries that have strong economies, healthy economies, that employ people, that provide some, social benefits and all of these things. These countries are the countries that have turnover every single day, and therefore their currencies are being exchanged every single day, and therefore those are the currency pairs that we should be trading in 2019 and going into 2020. I strongly believe that from this information, we're going to see more growth in China. You're going to see more traders coming out of China, more information coming out of China, which is never going to be a bad thing. We want to take all that information in and have it help us make better trading decisions going forward. I even think you're going to see brokers starting to list more currencies and getting better liquidity behind some of these emerging market currencies because more and more people are getting involved in the market.